Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. With interest rates rising and fear of a recession or maybe fallout from the bank crisis that we're going through, investors should be looking at companies that have a solid balance sheet to fall back on and a lot of cash. And so that's one thing that I dug into recently. And there was a few companies that really intrigued me with the amount of cash that they have on the balance sheet and what they could potentially do with that cash. That's what I want to do today, is highlight 3 stocks with a ton of cash on the balance sheet that may be a little bit surprising to investors. My name is Travis Hoium. Thank you for watching Riiv Investing. Please subscribe here on YouTube for all of my content on the market and great stock ideas. First, let's look at a company that has gone through a real roller coaster since the pandemic began, and that is Zoom. Zoom was obviously a darling early in the pandemic and really shot to profitability, grew faster than almost any other company because more people were working at home. And that's something that's actually continued for, I think, a lot longer than people thought. But at this point, the company has just kind of become a mainstay. Even for your average person, doing a Zoom call during a week is not out of the norm the way that it was just a few years ago. The company is profitable and it also has a phenomenal balance sheet. So I want to go through a couple of numbers here that investors should keep in mind. This is Zoom's balance sheet, and a couple of things pop out here. Cash and equivalents, $1.9 billion. Marketable securities, so that would be things like treasuries, $4.3 billion. So in total, you're talking about $5.4 billion of cash and equivalents on the balance sheet for Zoom. And down here in the liability side, no debt. That's just a phenomenal balance sheet. And this is a stock that has a market cap of about $20 billion right now. So more than 25% of the company's market cap is sitting here in cash. What's the reason for that? Well, Zoom is slowing down a little bit. In fiscal 2023, revenue was up just 7% for the year. Things are really slowing from where they were in the pandemic. They could even potentially go negative here in 2023 as more people go back to the office and we do kind of more normal things from a work standpoint. But I just think the base that Zoom is starting from is really incredible. Look at this full year number. Operating cash flow, $1.3 billion. That is down from $1.6 billion a year ago. So definitely moving in the wrong direction. But for a company that's trading at this kind of earnings and cash flow multiple and has a ton of cash on the balance sheet, I think there's a ton of optionality for Zoom. As we go into a little bit harder times for the tech industry overall, we could see Zoom become an acquirer of other companies that are trading relatively cheaply that bolt on to the service that Zoom is offering. I could see them being one of the aggregators here, building a mini office suite, if you will, to compete with Microsoft and Salesforce. That's a really intriguing for a company like Zoom. And keep in mind that money that's sitting on the balance sheet is also earning interest. So $5 billion at a 5% interest rate, that's $250 million in earnings just from interest, not from doing anything else with the business. That's really impressive. And it's just another reason to keep an eye on this company. I think it's really deep in value territory. And that's why I have it on my short list right now. The next company I want to look at is Snap. Now, this one's a little bit surprising and there are some caveats here, but Snap has a $17 billion market cap, has a really solid base of users, and is actually growing its users. And you may not realize it not only has a ton of cash on the balance sheet, it's actually free cash flow positive. One of the reasons that Snap is reporting negative net income right now is it's giving out a ton of stock-based compensation. Now, that's a story that we'll battle another day, but for right now, I want to focus on the cash that we have on the balance sheet and go through the numbers there and what they might be doing with that. This is from their recent shareholder letter. You can see at the end of the fourth quarter, 2022, almost $4 billion in cash, and they're actually repurchasing stock. And that's, as they say here, to protect shareholders from the impact of dilution from that stock-based compensation that I talked about earlier. If we go down here to look at cash flows, you can see that in 2022, despite a pretty rough year for Snap, still $78 million in free cash flow. Operating cash flow was $125 million. So those are decent numbers for Snap, given the fact that I think it hasn't really found its footing financially yet. They've introduced some interesting products recently with subscription service that includes some of the chatbot features that they're including in the Snapchat feature right now. So this is a company that could potentially be a turnaround play for investors, and the fact that it has a lot of cash on the balance sheet, I think is an incremental positive, but there is a warning, and that comes over here from Snap's balance sheet. So here's the cash and marketable securities they have. Just like Zoom, they're going to be able to earn cash from the interest rate on those marketable securities, but they're also sitting on $3.7 billion of convertible senior notes. That is debt that they're either going to have to pay back or will be converted in the future. But given the stock's performance, I don't think that would probably be the case. They'll have to come up with that money. So that is the downside, is that they have to do something productive with that cash in the near future. Otherwise, there's just no point in having it there. And borrowing cash to buy back stock is not really a good use of a company's cash. Snap is in an interesting spot where if they can take advantage of this current place where they have a bunch of cash, they can maybe bolt on acquisitions that will add to that free cash flow. That could be an interesting spot for them, but they do have debt hanging over the company. So take a little bit more caution with this one than Zoom. This is much more of a turnaround play than it is a value play. And the final stock today is Roku. Roku has a $9 billion market cap and almost $2 billion in cash on the balance sheet. A little bit like Snap, I do want to have some caveats here because they're not profitable right now, but they do have a really solid balance sheet. And I think if they can pull back on some of the operating expenses and really focus the business, this could be a great investment long-term. Let's start here with that balance sheet, $1.96 billion in cash and no real debt. They do have a lot of accrued liabilities and some operating liabilities from leases, but that's not all that surprising for a company like this. What I do have some concerns about going up here is the income statement and the statement of cash flows. I'll focus here on the full year numbers. I really like this platform business, very high margin, as you can see here, and this could be very profitable. I mean, this is where they're getting a vast majority of their gross profits. The problem is they're spending way, way, way too much on operations. $789 million on R&D, another $838 million on sales and marketing, and then $335 million on general and administrative. You have a company with a gross profit of $1.4 billion, but they're burning through almost $2 billion of operating expenses. That's not great, and it's actually getting worse. Management does have a plan, as they say here. Importantly, we plan to continue to improve our operating expense profile and hope to get to positive adjusted EBITDA for the full year of 2024. So that would be next year. This is one of those companies that I think just started doing too many things for too many business lines, especially during the pandemic, and grew those operating expenses too quickly. They're going to have to pull that back. But the good thing for investors is that Roku does have the ability to burn a little bit of cash in that process and try to build a solid foundation because of the balance sheet that they've built. And investors are getting a relatively good value from the cash standpoint with a $9 billion market cap. Now, long-term, they're going to have to focus on generating positive EBITDA and free cash flow. If they can't do that, this won't be a great investment. But there's at least a longer runway than there is with a lot of companies that don't have a great balance sheet. So that's what makes Roku intriguing. It's not one that I own yet, but it's definitely one that I'm going to keep an eye on, especially if those operating expenses start coming down. So there's 3 stocks with a ton of cash and a ton of optionality as we go through this turbulent economic time. Zoom, Snap, and Roku. They may be in a little bit better financial position than you thought going into this video, but I'd love to hear your thoughts on these 3 stocks in the comment section below. Give this video a like and, of course, subscribe to Riiv Investing. I really appreciate it, and I'll see you here next time.